The stock market generates billions of data points every day. Most of it is chaotic noise, but mathematical physicists like Jim Simons proved that within that chaos, tiny hidden market inefficiencies do exist. For traders, finding one of those inefficiencies is the ultimate goal. They want to identify a mathematical pattern that lets them reliably anticipate the market's next move and pull capital out of the noise. But humans have a built-in biological blind spot. It's called pareidolia. Our brains evolved to aggressively search for meaningful shapes in random environments, like spotting a face in a cluster of clouds. When a trader stares at the chaotic, jagged lines of a financial chart, that same evolutionary wiring fires up. They are biologically predisposed to see structure where absolutely none exists. In 1939, a man named Ralph Elliott spent his days staring at printed records of stock prices. This downward trending line graph illustrates the core of what Elliott believed he found. He claimed falling stock prices would predictably find support and bounce back up at specific intervals based on the Fibonacci sequence. Notably, the 61.8% retracement level derived from the golden ratio. Over the next 80 years, that single analog observation multiplied. Today, trading platforms automatically overlay these exact mathematical lines onto millions of screens worldwide. The finance industry treats these lines as a structural reality of the market. The question is whether the data supports that, or if this is a mass psychological illusion. To find out, researchers analyzed over 50 years of daily stock prices across the Dow Jones, the DAX, and the Nasdaq. The test was straightforward. If the Fibonacci sequence actually influences trader behavior or market structure, a falling stock price should bounce off a specific retracement line significantly more often than it would by pure chance. This split-screen comparison shows the methodology. One side tracks how often prices interact with a Fibonacci line. The other side tracks interacts with completely random control lines. After processing decades of data, the stock bounce probability matched the random control group exactly. At a specific price point, the golden ratio provides the exact same predictive value as throwing a dart while blindfolded. This diagram shows how traders usually defend the strategy. Human analysts rarely use exact price points. Instead, they draw a thick, semi-transparent zone around the Fibonacci line, a band of molasses, giving the price a wider area to reverse. To account for this subjectivity, researchers progressively widened the zones to see if thicker boundaries revealed a mathematical edge. Mathematically, a wider zone will always catch more bounces. If you cast a massive net into the ocean, you will inevitably haul in more fish. But when the researchers compared these thick Fibonacci zones to equally thick, randomly placed control zones, the bounce rates equalized again. Drawing a wider band on a screen gives the price more room to fluctuate, but it completely fails to uncover any hidden predictive advantage. The researchers ran one final test. They programmed an automated trading algorithm to buy and sell exclusively when prices entered these confirmed Fibonacci zones. This line chart tracks the financial returns over time. The bot trading on Fibonacci zones and the bot trading on completely random lines yielded the exact same flat performance. Despite 80 years of lore, applying the golden ratio to market data yields zero abnormal profit. If the math falls apart under scrutiny, we have to ask why traders still rely on this tool every single day. This chart, displaying a trader's visual perspective, explains the psychology. When an analyst manually draws a wide zone on their screen, incidental random bounces will occasionally occur inside that specific area. When that happens, the trader remembers the successful hit and forgets the dozens of times the price blew right past the line. They attribute random chance to mathematical genius. Extracting capital from chaotic markets requires objective, verifiable data. Subjective illusions, no matter how comforting or historic, eventually shatter against computational reality.